And now, as a part of this session, I want to have a quick recap with you that audit evidence session that we discussed, right? And ideally there should be MCQ for you to kind of, make sure that you understood. If I ask you, what are the two qualities of audit evidence? Answer is sufficient appropriate evidence. If I ask you, what is appropriate evidence? The answer is relevant and reliable. If I ask you another question, right, what is relevant evidence? The answer is relevant to assertion. If I ask you another question, can you rank audit evidence from the level of reliability? Evidence obtained directly by the auditor is more reliable. Evidence obtained externally is more reliable, right? Internal evidence are more reliable when internal controls are sound. Written evidence are more reliable than oral evidence. Now see that all these principles you have to have a very good knowledge. And then we said usually procedures to gather audit evidence can be broken down to two: RAP, risk assessment procedures, as well as further audit procedure. Now these are same slides I am taking from the session 1 that we did, as a recap. And then I explain to you, if I ask you another MCQ question, what is the difference between test of control and substantive? Answer is very sharp. And if you have already studied, you can give me answer in one word. One word to differentiate. The purpose of test of control is to test one thing, that is OE, whereas the purpose of substantive is one word, that is to detect. Now that is how very sharp student will give answers. But when you write this answer in the exam, the purpose of test of control is to test whether internal controls are operating effectively or not, and to establish that. But whereas the purpose of substantive procedure are those, right, is to detect material misstatement. Substantive procedures are those, right, procedures performed by the auditor to detect misstatement. So that is the difference. And then this is the interesting area that now we have to use. One of the very powerful techniques in auditing is analytical procedures, which I have already briefed you. But now, because we have already done the digital session and you saw the power of data analytics audit software, big data analytics, right? ADA you have already seen, then very easy for me to cover. So basically there is a separate auditing standard. Please write Sri Lanka auditing standard 520 analytical procedure. During next half an hour you are going to definitely learn, and then to see practical techniques, and then go and do some exam question. So basically one of the things that I want you to learn definitely is the definition of analytical procedure. Please write in your book. I see, although this is there in your chapter, some other chapter, in this chapter I didn't see the definition, but definition definitely you should know. Now we had one definition for data analytics. That is from remember that in my digital session you saw that word data analytics. So that is more from a system and angle, you mean the audit software angle, right, where we have statistical techniques angle. What is the definition? I said examination of data to discover three things, right? Pattern, trend, and third one, correlations. That's the definition given. But this definition is more powerful than that, because this is coming from auditing standard. Now, analytical procedure is a wonderful tool from auditor's toolbox, right, which enables auditor to do what? That is the question. Do what? Evaluate financial statement. Remember that word? Evaluate means you are going to look at financial statement critically and say, look here, PP is overstated, inventory is overstated. The fact that GP margin is unusual means the inventory may be overstated. Now remember, definition start with that word. You evaluate financial statement through a study of, what is the word? I am writing that word, plausible relationship. See the word? In analytical procedure we are looking plausible. You can look up the dictionary for this word, plausible relationship. Plausible means these usual relationships should be there. When sales increase by 10%, cost of sale has to increase at least by 10% or 9%. But if you see a trend, when sales increase, cost of sale decrease, that is not acceptable. So evaluation of financial statement by studying plausible relationship, and if you see anything unusual, then analytical procedure also involves investigation. Now, if sales has increased by 10%, cost of sale has decreased, you investigate, you get into more detail to figure out why cost of sale is unusual. So, analytical procedure also include investigation of differences which are different from auditor's knowledge or the industry practice. So, having understood the definition of analytical procedures, before I proceed further, remember this is auditing standard, Sri Lanka Auditing Standard 520, ISA 520. I want to question you again. If I ask you what are the two parts of the analytical procedure definition, only brilliant students can answer. I hope you to always be a brilliant student. What are the two parts? One is, using analytical procedures, you evaluate financial statement. So that is why definition starts saying that it is about evaluation of financial statement by studying what relationship? Plausible relationship. Plausible means the relationship that we expect. When the sales increase, cost of sale is supposed to increase. That's the expected relationship, right? If sales increase, the cost of sale reduces, your GP margin will change significantly. We are going to look at case studies definitely, right? Then you will understand how powerful and how interesting analytical procedure is. So I said two parts of the definition. Two words to remember, that is how brilliant students remember definition. One is the evaluation word, the other one is, okay, you evaluate and you see the GP margin, like I said, what has happened is from 21 to 2020, let's say, if these are the period that you are studying, that let's say sales increase by, now compared to this year, right, the sales has increased by, say this is 100, and now this has become 120. And the cost of sale, let us say, about 20%. Now, cost of sale is 80 here, right? And then you have a GP of 20, and your GP margin is 20% here, right? And now, let us say that when the sales increase, the plausible relationship. Now, see, the one word is evaluation, right? Two words only I want to remember. We evaluate financial statement, but remember when you read the word evaluation of what? The relationship that should be there, right? Plausible relationship. Now, ideally, right, if sales increase by 20%, then this also should increase by 20%, right? Then your GP margin will not change. No, if you say 20% is 16, that is 96. Now let us say this works the other way around, which means when the sales increase, cost of sale unusually decrease into let's say 60 is really unusual. Then you get a GP margin, significant improvement, that is 60, and you can now see if you calculate GP margin, it is significantly higher, no? So that is 60 divided by 120. So your GP margin is going to be 30%. It's a significant increase, right? And now this increase, this is let's say computer, this business is in computer buying and selling. Usually the industry norm is 20%, right? The industry margin that any company can keep, let us say, that is why analytical procedure is so powerful, that every computer buying and selling company, from the auditor's knowledge, that margin is, GP margin is somewhere maximum 15 to 20 range. Now earlier also this 20% is this company like, you know, getting a higher margin, but now this year 30% is totally outside the auditor's knowledge, right? Outside the knowledge, it's questionable. So why there is 30% GP? That's really questionable, and that is where you will learn in subsequent slide. The analytics alone, very powerful question to ask. Can analytics alone be used to gather audit evidence and to say definitively something wrong in either sales or cost of sale? But remember, when we say cost of sale, you have to go to breakdown. Now, when there is a cost of sale problem, you know, naturally when you analyze financial statement, you have to write your answer. In your answer, you will say that the GP margin has unusually increased. This is because, right, when the sale increased by 20%, the cost of sale has cost of sale has decreased, right, by a significant percentage, right? Now this is unusual, and this may be due to, that may be due to is very important. Now one of the very interesting item in cost of sale is stock. Now, auditor can also assume this may be due to either misclassification of some expenses. Earlier, something that is used to be under cost of sale, now they are putting somewhere else to maybe deliberately to improve GP, or that there is a change in stock valuation policy. Now, that is how auditor use professional skepticism. Now, auditor recall, okay, during the initial discussion with the CEO, he mentioned that this time they have changed, you know, the way they look at inventory. Look at means they have done something, right? So that is where, you know, one of the very important thing that I showed you, analytical procedure involves what? Comparison. Now, you evaluate, compare and see if there is anything unusual. This is unusual 30%. Next word is investigate. So I highlight that word as well. So the next powerful word is what? Investigation. What are you investigation? Not everything. If there is a fluctuations, right, that has to be material, right? That significantly, this is the word, significantly means materiality. Deviate from the prediction. What is your prediction? Prediction is this 30%. How it is a prediction? It is the industry, prediction is 15 to 20 because it's the industry norm. Now that is how, you know, if you really understand this, you are good so far. But next few slides I am going to technical details of in an audit. From audit perspective, while analytical procedure, when you become a chartered accountant, this is one of the unique things. You can very quickly look at numbers. You can just read a balance sheet and a P&L and say, okay, this looks unusual to me. Let's say you are explaining this to a CEO who doesn't have any understanding about numbers. You are seeing something wrong in this company's profitability, and that's the benefit that you can give. While computer can do these various ratios, you are only able to use your professional judgment and to comment whether this change is acceptable or not, right? So therefore remember that. Now let's go to little detail of this.